Let me invite Ashley to continue with this session.
This session is going to focus on discounted cash flow and net present value. So this is going to get fairly quantitative. So discounted cash flow and net present value are all about the time value of money. Getting $1,000 next year isn't worth as much as getting $1,000 tomorrow, right? Because spending $1,000 tomorrow is worse than spending $1,000 next year. You'll get more for it tomorrow than you will in a year when you've had inflation. And it's just like interest, but going backwards. And we all understand interest because we have our mortgage, we have our savings accounts, our retirement accounts. We understand that, but it's somehow much more difficult to understand when we're going backwards. So the interest rate going forwards becomes the discount rate going backwards. And net present value calculations take into account the facts that the expenses are certain and early. If you set out to develop a technology, you will spend money and you will spend it upfront. The return is later and uncertain. The product may not succeed. The market may not be there. So let's assume that something's risk-free. Inflation currently is around 3%, a little less than that in the US. Assume you're happy with the 7% return. So 3% to cover inflation and 4% as a return on your investment. And there's no risk. So the calculation we make for that is US government treasuries. It is assumed that the US government will never default on its debt. That debt's getting pretty damn big. We'll see how big it gets, but that's a discussion for another day. So if you invested $1,000 today, you'd expect to get $1,070 back in a year's time, right? What about the second year? If you left your money on deposit a second year, would you expect another $70? No, you'd expect more. Because for the second year, you got $1,070 invested, not $1,000. And you'd expect a return of 1,070 times 0.07, which is about $75 for the second year. So going the other way, we want back 1,070 in a year if we invest $1,000 today. So we'd be willing to invest 1,000 divided by 1,070, or $934 today to get back $1,000 in a year's time. 7% is 65, add it up, and we've lost the rounding, okay? So that shows how it works. So the value today of $1,000 in a year's time is $934. So $934 is the net present value of $1,000 1 year out with a 7% discount rate. 7% is the interest rate going forward and the discount rate going backwards. So the future value, FV, 2 years in the future, is 1,000 plus 1,000 0.07 plus 1,000 plus 1,000 times 0.07, all times 0.07. That's the present value, the interest for year one, the interest for year two. And you can start to convert this to algebra. FV is our present value times K, our present value plus our present value times K, and high school algebra says that's the FV is the present value times 1 plus K squared, okay? So the net present value of an amount 2 years in the future is F PV is FV over 1 plus K squared. And if you apply that formula, you'd pay $873 today to get back 1,000 in 2 years. So 873 is the net present value of 1,000 in 2 years with a 7% discount rate. 7% is the interest rate going forwards and the discount rate going back. And I won't go to the third year, but it turns out that the formula generalizes to PV is FV plus 1 plus your discount rate to the power n, where n is the number of years you're going forward. So because of this n, the value of K has a very, very big impact. So multiple payments, if you wanted to get back $1,000 in each of the next 2 years, you'd be willing to pay $934 for the first year, $873 for the second year, a total of $1,808 today. So $1,808 is the net present value of two $1,000 payments, 1 and 2 years out, with a 7% discount rate. So let's look at discount rates. As I said, inflation is 3%. The long-term Treasury bill rate in the US has been about 7%. And this was the sort of numbers pre the great financial crisis. After the great financial crisis, interest rates were much lower, and these numbers looked unrealistic. They're coming back to look realistic now. But I think that when I look at what's happening in things like royalty monetizations, these numbers are still kind of what people look at, okay? So the corporate bond rate historically used to be 12% if you were a very high-grade company, because it's riskier than the US government rate because big companies can't print money, and then 18% for junk bonds. And if you looked at the capital structure of big companies who raised money through a combination of selling shares, borrowing money short-term, and borrowing money long-term, when you look at the blends of those, the average corporate cost of capital for a big company is about 15%. And the corporate investment hurdle rate is 30%. When I was at Procter & Gamble, if I wanted to propose a capital investment to the company, I had to show that they could get a 30% return on their money. Because they said, okay, it's going to cost me 15%, I want to double my money. That was the hurdle rate. And the venture capital investment rate, they say, look, our stuff is so risky, we've got to have a 50% annual return. So if you look at the effect of the discount rates over long periods, this graph shows that 3% is inflation, and over 20 years, you can see the value of your money has gone down almost by half, okay? That's why saving for retirement is so difficult. You've got to allow for the fact that you're going to continue living after you've stopped earning, and prices are going to get higher and higher. 7%, you're down to a quarter at the end of 20 years. 12 and 15% are down here. You're down to about 10%. And the 30 and 50%, you're wiped out even earlier. So the formula is 1,000. So let's look at the net present value of $1,000 in 5 years. The formula is 1,000 over 1 plus k to the power 5. So 3%, the value is $862, and you're getting back 15% more than you invested. Kind of logical, right? 3% times 5 years, not much compounding there, 15%. 7%, the value today is $712, and you're getting back 40% more in 5 years. 12%, $567 today, so when you get your $1,000 back, that's 76% more than you invested. 15%, you're almost doubling your money. 30%, you're getting almost 4 times your money back, and 50%, you're getting 8 times your money back. Remember, I said venture capitalists say we want a 50% hurdle rate. That's why they'll tell you they have to be able to see a 10x return on any investment they make. They know they're not going to get 10x on every investment, but if they make 10 investments, they get 1 10x, 3 or 4 2 to 3x, and the rest write-offs. That will give an acceptable return that their investors will invest in their next fund. And that's what they care about. Okay?
Might want to explain what's your equation for payback?
So this is our future value, is our present value over 1 plus k raised to the power 5, because we're going out 5 years.
Yeah.
Okay? And as I said, because the 1 plus k goes to the power 5, when it's 1.5 with the 50% to the power 5, that's very different from 1.03 to the power 5 in the 3% inflation case. This is why the discount rate you use has such a major impact.
I'm not sure if people understood. They got the future value thing, but is everybody clear? It's an important concept here, which you might want to catch it.
Initial slides he explained.
So, good. Okay, good.
So it's kind of this graph cut off at 5 years. Okay? So you can see at the 50% rate, we're getting 8 times our money back. If we get $1,000 back for what we invest here, and at the 30%, we're getting 25%, 4 times back, and so on. Okay? It's taking into account the big impact that the discount rate has because we raise it to the power 5. Okay? Not sure I know how to explain it any more clearly than that.
I just meant that in your equations,
Yep.
your payback refers to if K was actually the interest rate,
Yes.
compounding interest rate, what would be the number that you would earn, right?
Right.
So that's what it is. The formula you have put down is for the present value.
Yes. So this is really the ratio of the future value to the present value. 3%, the future value is only 15% more than the value today. But at 50%, the future value is 8 times what it is today because we've got 1.5 raised to the power 5.
Yeah. Another consequence of this graph is that if you go to a venture capital firm and they ask you for projections, right? They don't want to see more than 5 years because they don't care.
Yeah, and they're not sure at this point you can accurately project 5 years.
Yeah, the risk is too high also.
Yeah. So let's look at that license project we looked at earlier, right? We invested 10 million over 6 years. The sales started in year 7. The operating costs were 5% cost of goods sales. Sales and marketing 10% of sales. General administration 5%. Ongoing R&D 2%. The peak profits were 18 million in years 12 to 14, declining to 11 million in year 20. Total net income was $174 million. Okay? And so the net profits exceed the investment, the 10 million investment, by $164 million, right? Looks like a great deal. This is what the cash flow to the company looks like. We looked at the revenues to the licensor earlier, but this is the cash flow to the company. Here's where they're investing. Here's where they start selling. Comes up, hits the peak, and starts to decline. This is what the cash flow looks like at different discount rates. So this one, the 0% discount rate, that's what we just looked at, okay? This is the cash flow at a 3% discount. And you can see we've lost about, what, a quarter, a third of the value. Here's the 7%. Here's the 12%, the 15%, the 30%, and the 50% discount rate. They really got squashed down. Look how much those sales have got squashed down with 13 years of that discount rate. Now, the investment gets squashed down too, but it gets squashed down less because it comes earlier. And so N is smaller here than N is out here. Out here, N is 14, right? So the answer is it's still a good deal. Depends on the discount rate. At 0%, the net present value is 164.3, and you got 16.4 times back your investment. 3%, the net present value of all those cash flows is $107 million, and we got back 10.7x our investment. 7%, 61, we got 6 times our money back. 12%, 31, 3 times our money back. 15%, twice our money back. 30%, 0.1 times our money back. And 50%, we've actually lost money. Okay? But let's look at that 30% case. The licensee achieved their 30% return because we discounted everything by 30%, so they got their 30% return. And the project is still worth $979,000 today. That's the amount you can pay the licensor, and the licensee still gets their 30% return. You could ask for $979,000 up front. They won't give it to you because it puts all the risk on the licensee. So the license terms are, in our example rate, have an NPV of $864,000 with a 30% discount. So that shows that's pretty close to the economically rational license terms. The NPV is still $115,000. So you can use Excel, and they have a goal seek function, right? So you could set the licensor NPV to 0 and say, how do I get that by changing the running royalty rate? And the answer is you get a 6.4% running royalty rate would get the NPV to the licensee to 0. Or you could say perhaps increase the final milestone payment. And if you take the final milestone payment, we had at $500,000 to $930,000, then you get back to 0 again. The mechanics, it's easy to do this in spreadsheets. And Excel has an NPV function, handles up to 29 years. I usually do it by doing my own. You set up, you calculate a discount factor for each year. First year is 1, second year is 1 plus K. You put K in a box so you can vary it. The third year is the second year divided by another 1 plus K, and so on. You multiply each year's cash flow by that year's discount factor, and you add them up, and that's your NPV. So where do you get the data? Well, you can ask the licensee for their projections from their business plan, what they've presented to their board, what they've presented to investors. You can look at analyst report. In the drug industry, analysts do very detailed projections of what these companies they're following are so they can give investment advice to their clients. So trust, but verify. So let's think about combining the 25% rule and NPV analyses. The 25% rule allocates net profits between licensor and licensee, right? Reflects past and future financial risk. NPV is the best measure of net profits. It's the net profits, what they're worth today. So you can apply an NPV analysis of the licensors and licensees. Oh dear. Nope, I don't think that has one. Okay. So you can apply the NPV analysis of the licensors and licensees' cash flows and see how they compare. That's called an NPV split analysis. So you model the drug's commercialization, calculate the NPV, create deal terms that split the NPV between the licensor and licensee in percentages that depend on the stage of development of the drug. There's no official scale. Each company and business development executive has their own objectives. An early stage biotech entrepreneur said he tried to get 5 to 10% of the NPV for preclinical. Phase 1, 10%, phase 2, 20%. A large pharma company said 40% in phase 3. This is some data that comes from an LES paper, looking at what analysts are looking for: preclinical, phase 1, phase 2, phase 3, commercial. So in the example we looked at above, with an 11% discount rate, the project has an NPV of $35.6 million. The licensee NPV is $31.9 million. The licensor NPV is $3.8 million. So the NPV split is 10.4% to the licensor and 89.6% to the licensee. And here's what the spreadsheet looks like. Shame I haven't got I do have a pointer. No, we do it by year. This is the product sales. They start in year 7. These are the costs. This is the R&D expenses, the patent costs, the R&D expenses, and these are the ongoing sales, marketing, and administrative costs. You can see this generates, this is the discount factor, 1 for year 1, 0.9, 0.81, 0.79, and so on, 11% discount rate. And that's our NPV of $35.9 million. And you can see I take it out to year 20 here. And you can see in year 20, the discount factor is 0.4, or 0.14. So, all those sales don't contribute very much to the NPV back here when you're discounting out that far. And here I show you, this is the licensee's NPV by year, and this is the licensor's NPV by year. The licensor doesn't have any investment, right? We were getting payments all along, so it was positive to us. That's making these further negative than they would be if they weren't paying us royalties. And here we go up and down. So what if the licensee insists it won't go higher than a 7.5% NPV split? Well, you use GoalSeek. Set the licensor NPV split to 7.5%, vary the running royalty rate, and the answer comes back at 3.1%. Okay, let's go back and have a look at that. So you would set, you've got a calculation that shows, and I didn't put it on here to simplify it, but you've got, this is the product NPV, and then you do the NPV analysis for the licensor and the licensee, and you have the ratio, and that came up at 10.4%, right? And so you would set that to be 7.5%, and to get there by varying the running royalty rate. And as I said, the answer comes back, instead of 5%, we get 3.1%. So, do I go there? Oh, late stage drug deals. Phase 3 drug deals are frequently 50-50, where the licensor The biotech company pays half the cost of development, and the big company pays half. And for that, and perhaps the small company will contribute part of the selling effort. And they go for a 50-50 profit split. So as an example, the University of California, Los Angeles developed what is, I hope nobody in this room has had it, it's a drug called Xtandi, which is the best drug there is for advanced prostate cancer. They licensed it to a company called Medivation, which took it into humans, and when they waited until they dosed the first patient in phase 3 to do their deal with Astellas, because the sub-license income sharing percentage went down at phase 3 to 15%, I think it was. So they waited till they dosed the first patient and then signed the deal. And Astellas took the drug to market, and UCLA later monetized its royalty rights, got $1.1 billion, having already got $300 million in payments up to then. And then Pfizer came along and bought Medivation for $14 billion, even though they only had half the US market rights and none of the worldwide market rights. So it was an amazing deal. So Medivation licensed 170 diarylthiohydantoin compounds in 2005, called the RD series. They bind and inhibit the androgen receptor. It was preclinical, and the terms were $15,000 up front, $2.8 million in milestone payments, 4% royalty on sales passed through to sub-licensees, 25% down to 10%, depending on the clinical stage when the sub-license was done. R162 prime became Xtandi. It's their best drug for advanced prostate cancer. 2019 sales, $4 billion. 2009, Medivation did the deal with Astellas, drug just entering phase 3. As I said, they probably delayed the deal till the first patient dosed. I did a lawsuit on this, so I saw some of the internal deliberations of Medivation, and they said, wait, don't sign that yet. So they absolutely delayed it. They got $110 million up front, $335 million in developmental milestone payments, $320 million in sales milestone payments, and a 50-50 co-development and profit sharing in the US, and running royalties in the rest of the world, tiered from the low teens to the low 20s. And I, for my modeling, assumed the same as they got from Pfizer for an Alzheimer's and Parkinson's drug about a year earlier, where I could actually find the actual royalty rates, because that agreement was filed with the SEC. That was 12% up to 500 million, 16% up to $1 billion, 20% up to $1.5 billion, and 24% over $1.5 billion. And I've seen the actual license agreement. As I stand here, I don't remember if those are a good estimate or not, but that's what I could use in my model. So in March 2016, they monetized their royalty rights, as I said, having already got $300 million. And I'm kind of proud of this. The model I built said that the payments were worth $1.105 billion. Honest, that was the first answer that came out. I didn't have to tweet to get there. I was really proud of that. As I said, in August 2016, Pfizer acquired Medivation for $14 billion, and my model said $16 billion. I still think that was pretty damn good. Look at that build-up in value. In 2005, following the biobucks we looked at this morning, the lump sum payments, $3 million, preclinical. 2009, phase 3, $775 million. And 2016, the value is what UCLA's got for royalties and what Pfizer agreed to pay to buy the company, $15.4 billion. Wow. So the NPV analysis, I used the sales forecast. I had the actual sales through 2016 from Medivation's 10Ks. Analyst reports for 2016 to 2021, showing a compound average growth rate of 14.3%. And I assumed that they would grow at 14.3% through August 2027 when the UCLA patents expired. That's what you can get from the Orange Book. That allowed for any increased royalty term for time lost at the FDA or the Patent Office. I assumed a 50-50 split of sales between US and rest of the world after 2019. Profitability, I assumed the US profitability of 65% continues and applies in the rest of the world. You could get those numbers from Medivation's 10K. The NPVs in 2009, UCLA was $716 million, 2.9%. Medivation's NPV was almost $10 billion, 40%, and Astellas's was $14 billion, 57%. So why does Astellas get 57% when it's a co-development and co-promotion and a 50-50 profit split? Shouldn't Medivation and Astellas get the same? No. Medivation bore all the costs up to phase 3. That's why I think their NPV goes down. And they only get tiered royalties in the rest of the world. So risk-adjusted NPV, also known expected NPV or ENPV. So in the 1980s, risk was accounted for by unbelievably high discount rates. The analysts said, well, drug development is really risky. We're going to assume an 80% discount rate for discovery phase. And these models resulted in a negative NPV for drug development projects, which meant that no rational company would do it. But they were doing it. So the model had to be wrong. And what happened was data on success rates by clinical stage, accounting for risk explicitly, began to become available from the Tufts Center for the Study of Drug Development in 1995. This unit had been set up by a former commissioner of the FDA, Louis Lasagna. Because he came from the FDA, the drug companies trusted him, and they collaborated and gave them data, and they started publishing data on the success rate of going from phase 1 to phase 2 to phase 3 to approval, etc. And so this allowed you to account for risk explicitly, not just by the blunt instrument of using an 80% discount rate in the early stages. So I modestly can say I invented and published this risk-adjusted net present value. I published it in an obscure journal, or it was obscure at the time. It is now called the Journal of Commercial Biotechnology. And alas, it is only available online from about 5 years after I published. So it's very difficult to find my paper. But Richard Razgaitis read my paper, and that book of his I showed you, he gives me credit for it. So that's where it is. Now, if only I had been able to patent that method of doing business and got a fee from every time somebody used it, but alas, I didn't. It was before the State Street Bank decision that let you get patents on methods of doing business. And big pharma's developed both NPVs and risk-adjusted NPVs. They particularly use the risk-adjusted when they're looking at their overall development portfolio because they know not everyone's going to work out. And that's how they account for that risk. So that's the model. the hurdle. You can get it on my website. These are some of the data on the stage success rate. This is the original Tufts study from 1995. That's another one they did in 2010. This is a study the FDA did. And the Bioindustry Organization publishes very comprehensive collections of success rates by stage. They do it by therapeutic category, type of molecule, where the molecule came from, whether it was partnered, all sorts of stuff. And this is their one published in, 2020. That's probably another one in the works. There's another one from a company called Takebe. And these are the median rates. So here's what these look like when you put them together. So this is, you go from preclinical into clinical. So this is your probability of success for going from phase 1 to phase 2 to phase 3, phase 3 to NDA submission, and to approval. So you multiply them together to get the cumulative rate, and you can see only about 10% of drugs that enter clinical testing result in a marketed product. Okay? So here's the risk-adjusted NPV analysis of our example. I put the phases in here, and this is the discount factors. And this is the risk-adjusted net present value at different stages of development. This is negative preclinical, pretty low at phase 1, and then goes up, and obviously at NDA, when there's an 85% probability of approval, it's 49, and then the full molecule, when it's approved, is 66 million. And this is the RMPV versus the stage of development of it. So this all looks very sophisticated, but you can see it's built on simple spreadsheets and simple sources of data. There is data out there. And this is the RMPV at different stages of development. List pricing. As you get more familiar with tech transfer and do more deals, you'll have a good feel for what a technology is worth. You won't need to go through specific valuation exercises for each one. Getting paid, it's important to have a good tracking system, know when reports and payments are due. My policy at BU was if a payment was due on a Friday and it wasn't in Friday's mail, on Monday we called them. Have you mailed the check? Is it in the mail? Follow up immediately. I don't think I ever didn't get a payment that I was due. You've got to be, no hesitation to say, hey, where's the money you owe me? Okay? We don't want to go through all this work and, it's a startup company and they don't pay their patent bills and we don't chase them. And then suddenly they go bankrupt and we're stuck with unpaid bills. Pursue payments when they're due. Trust but verify. Track the licensee's progress from their website, from press releases, SEC filings, Google Alert. Tracking responsibility has got to be clearly defined in your office, whose job it is. Is it the licensing officer who did the deal? Or is it an alliance manager who overlooks things after the deals are done? Larger companies generally have a different person to manage the alliance. In small companies and universities, it's normally the person who did the deal, who knows the people and stays in touch. You may be asked to forecast income for your leadership. They want to know what income they can expect. 1 year forecast will probably be part of your budget presentation, and you really should be able to forecast 1 year out with reasonable confidence. Ask the licensees for their sales forecasts for the marketed products. They're going to have them a year ahead. And compare with their public announcements. The wild card obviously will be new product launches. Is a new product going to hit the market during the next year? And when? and its success. The longer your forecast timeline, the more uncertainty. I would try to avoid firm forecasts. Talk about the pipeline. If you have to forecast, probability adjust the numbers. Okay? If they're in phase 1, 10% of the numbers, and so on. Okay? And prepare for major patent expirations years in advance. And it's amazing. You know when it's going to happen. And like MIT, their big royalty earner was they had one of the patents on digital TV. And they knew exactly when that was going to end. And Lita Nelson swears she spent years preparing the president and the board of trustees for when that royalty stream was going to end. Remains, she retired the next year. Okay, Joyce Brinton the same at Harvard. You've got to prepare them. Nobody screwed up. Nobody messed up. It's a feature of the patent system. As I said, it's amazing how many directors retire the year a major patent expires. And if all else fails, 5%. Here is an agreement. It's called an indenture. An indentured servant, interesting, between the University of Toronto and the Eli Lilly Company. And it's dated the 30th day of May, 1922. Anybody know what this agreement is? Insulin, the first major university license in healthcare. Okay? Indenture? I'm not sure we look upon our licensees as our indentured servants anymore, but they did back then. And they paid a 5% royalty for a 1-year exclusive. So a 5% royalty in healthcare has a long and glorious history. See if I have anything more after this. Yeah, we do. If you want to see more detail on this, WIPO hired me to take this and turn it into a book. And the second half of the book deals with capitalization tables and startup companies and how that works as a vehicle for extracting the value of your technology. That's the URL. If you just go to the WIPO website and put my name in the search box, you'll find it. I think fairly low down. I've done a lot of stuff for WIPO since. So questions?
Any other agency?
No, I think I put everything I had into this.
Okay, thank you so very much, sir.
There are, as I said, there are databases you can use.
Yes, sir.
There's the Autumn database, things like that.
Okay, sir. Thank you.
Okay, we talked about valuation for exclusive, I understand, but in case of non-exclusive licenses, there could be 2, 3, 4, 5 licenses. So is there any change of approach while dealing during non-exclusive licenses?
So the rule of thumb is that a non-exclusive license gets a royalty rate half of a exclusive license. It's kind of funny. I've seen studies where people got all the data from the public sources that I've shown, and they couldn't show a difference between exclusive and non-exclusive overall. But when you look at certain license agreements, perhaps it's a non-exclusive license agreement, and they've got a defined option period to convert it to exclusive. And if they do, the royalty rate doubles. And other ones where if they fail certain things, the license goes non-exclusive and the royalty rate halves. So there's good evidence from agreements like that that a good rule of thumb is half. Another thing I discovered in a lawsuit I worked on, which was I did actually help Genentech in a dispute with City of Hope over the Kabili license. You know the Kabili, the co-expression of both chains of a monoclonal antibody in the same cell line? You know, critical technology. You had to have it for any synthetic monoclonal antibody. And this technology was jointly owned by Genentech and City of Hope Hospital. City of Hope Hospital made about $3.5 billion in royalties from it. It's, I think, the single most valuable academic patent you can find. And looking at this, I got to look at a number of license agreements that have been done for it. And most of them were just Genentech and City of Hope, the licensee, and it was 3%. But some of them, they were cross licenses. The licensee had something that Genentech wanted, and so they licensed them back and forth in the same agreement. And I observed in that if there's a cross license, the royalty rate is generally halved to reflect the fact you're getting something in value back. But I've never seen that written up in an academic journal, and I'm not sure I would be allowed to publish it anyway.
What would happen to the royalty after the expiry of the patent?
So it depends on the deal you struck. If you've just licensed the patents, then obviously the patent, when it's expired, they don't need the license anymore. So do you think the royalty payment should stop the day the license expires?
Should continue.
Why?
At
Why?
a reduced rates because they are producing the products and selling it in the market with our technology.
Well, if you license them know-how and patents, then sure, you should get some money for the use of the know-how after the patents expire. As I said earlier, the rate has to go down. It doesn't necessarily have to go down to half, though that's what people have traditionally done. It has to go down. But if you only license them the patents, okay, and the patents expire, do they stop paying you the day the patents expire? Yes?
Ideally, they should. Ideally, yes.
Well, I had that happen. My biological drug, the patents expired, I think, on July the 11th, and they gave me, 11 30ths or 11 31sts of that month's sales. And I said, no. The license you had, what is the license we grant? No. What's the precise grant language you include? No. I grant you the right to make,
Sale
use,
product.
and sell. And it gets expanded. Have made, have sold, have used, etc. You don't need a license to use or sell after the patent's expired. But you needed a license to make all the material that's in inventory on the day the patent expired. Okay? And you should get paid the royalties when they sell that. So I told my licensee that. I said, no, you owe me money on your sales of the product you had in inventory. I said, no, we don't. Okay. I audited them. And I had a very old license agreement. It didn't include the right to have them pay for the audit if a significant discrepancy was discovered. I hope your licenses have that. I had to pay $35,000 to have them audited, But the audit report came back and said, yep, they owe you $500,000 for the product they had in inventory. You know, biological supply chains are very long. You know, typically 3, 4, 6 months inventory at any time. So at that point, they paid me my $500,000. It was a good investment in the audit. Any other questions?
One more question. How do we calculate if we have only a part of the product which they are going to make it? Like if we have only an intermediate for the drug, or like a part of a battery, only an electrode or so?
Well, you know, can they make their product without you?
No, not.
In drugs, I mean, one of the issues you get is, particularly in biological drugs, in the early days, there were many enabling technologies. You know, I mean, starting with in biological drugs with Cohen-Boyer, and then getting things like the Axel patent from Columbia and so forth. I once calculated that the total royalty burden on Humira at its peak was about 25%. That's a lot of royalties, many different institutions. And then the patents started to expire and they went down. Royalty stacking used to be a big feature of negotiations. My initial model when I was licensing drugs was to get a relatively high royalty rate, and then there would be discussions of stacking if they need additional patents. And we tended to finish up at a 50% offset up to half of the original rate. I later adopted a model of, and then my sub-license income sharing was the percentage of all revenues. And we later moved to a model where we went for a lower royalty rate, but passed through to sub-licensees. So that eliminated all the sub-license royalty sharing rates. And I think we only went for 3%. I think now people go for 4%. And on stacking, we said, nah, you can afford a 3% royalty rate, and it eliminated the whole stacking argument. So I reckon that we got about as much money out of them, and it sure simplified the negotiations. How are we doing on time? Because I've got a little more stuff we can go through.
Yeah. I think you have some case study, right?
Yeah.
Yeah. Let's go through that, please.
Okay.
We can take about half an hour.
It won't take that long.
Okay, 15
So,
minutes.
Juno versus Kite. Juno and Memorial Sloan Kettering, from whom Juno had licensed their key chimeric antigen receptor T-cell technology, they sued Kite over their first marketed drug, Yescarta, in October 2017. That was the patent number 7446190. Expires May 2023. Now, Kite got bought by Gilead for $11.9 billion in August 2017, and Juno got bought by Celgene for $9 billion in January 2018, and Celgene itself got bought by Bristol Myers Squibb for $74 billion a year later. So, chimeric antigen receptor T cells are pretty big stuff. Yescarta was approved in October 2017 for relapsed or refractory large B-cell lymphoma. Its 2019 sales were $489 million, and 1.47 was forecast for 2022. Bristol Myers Squibb was awarded $752 million in damages in December 2019. So you can see about 2 years after the drug got launched was the length of time it took for the drug, for the lawsuit to go through. Let's do an NPV analysis of Yescarta. So first, construct the actual sales projections. Actual sales are available up till 2019 when they got bought from Juno's SEC filings. And projections to 2022 were available. And this is what the sales look like. 20 million in 2017, climbing up to 1.47 in 2022, and that is the pro-rated share with the patent expiration in August of 2023. Royalty rate, we have the MSK Juno deal terms, mid to high single-digit royalties. I interpret those as 5 to 9%, and I use 7% in the midpoint of that range. So there are the royalties, 7%, 1 billion, up to 103 million in 2022. Discount rate, I inflated the past royalties to mid-2019 and discounted future royalties back to mid-2019. And I used a standard 11% discount rate. I talked to people involved in royalty monetizations from time to time, and I think that is pretty much the standard discount rate people use. And this is the discount rate. So we're increasing the royalties back here, and then we're discounting them going forward. And here's the discounted royalties, multiply 1 by 1.23. Obviously, that was obviously more than 1, just rounded, and so on. And so the total, the total is $279 million is the NPV of the royalty stream. So 279 million, the award was 756 million. Why do you think that was? We can use the goal seek function. We set the NPV to 756, varying the royalty rate to get there. So, here I set my NPV, set my NPV to 752 million, and then vary the royalty rate to get there, and we've gone from 7% to 18.9%. 7% litigation, 18.9%. Why do you think that might be? Well,
based on the performance, company's performance,
the which?
the licensing performance.
No, I don't think so.
The new company which acquired found that the patent or some patents or has been used by the other one for a long time, and by calculating that time, and according to that they set this new royalty.
No, that's not what I'm getting at. Juno and Memorial Sloan Kettering agreed to 7% royalty, and the judge said no, pay an 18.9% royalty. Why was it 7% in the license and 18.9% in court?
Penalties?
Yeah. So what was the stage that the drug was at when the license was done? Some sort of preclinical stage.
Yes,
Okay? In litigation, you agree the royalty rate the night before infringement starts. That is the later of when sales start or the infringed patent happens. So by now, all that risk has been eliminated, so the value goes up. The value goes from 7% preclinical to 18.9% in litigation the eve when the drug is approved and sales will start the next day. Okay, in litigation, the patent is presumed valid and infringed. In licensing, there is uncertainty as to the validity. In litigation, royalty is determined on the eve of infringement, which is the later of patent issuance and product launch. The license is done at a much earlier stage, And the royalty rates for marketed products are much higher than for preclinical phase 1 products, as we've seen in various examples today. Okay? That's a nice case study illustrating this. I think chimeric antigen receptor T cells were just a part of academic research that's had just such a massive impact on cancer treatment, and you can see the value it created. $9 billion, $11 billion in the acquisitions.
Any questions?
Can you just speak a little bit about material transfer agreement valuation? No, about when we transfer material transfer agreement, for the material also we have some valuation.
There's no valuation in material transfer agreement. You know, you're giving somebody the material to evaluate usually. If you're going to give them the right to sell it, then that's a license. Now, I've come across major litigation over MTAs that went wrong. Okay? But interinstitutional agreements that went wrong can result in litigation.
No, in case like I'm discovering some microorganism, and that is being used in the product. And so when I'm licensing my product, I'm also licensing the know-how about this bacteria being very efficient for the process.
Yep.
So
But that's in the license agreement, it's not in the MTA. An MTA doesn't give them the right to use the product commercially. Okay? It's the license agreement that gives them the right to use the product commercially.
So that's factored into the license agreement.
Yeah. Yeah.
And does that this know-how lives even after the patent expires? Or?
Hell yes. As I said, this hybridoma that makes one of the standard cancer tests. They were all licensed as hybridomas, and this Japanese company is paying royalties 40 years later.
Thank you very much. Thanks a lot, Ashley.
Okay.
Let's give him a round of applause.
I got to teach this on an accelerated schedule downstairs first thing this morning. So this is the first time I've taught valuation twice in one day. I will always remember this day.
Okay. Yeah, you want to just start it off? We'll just do just go through quickly. We'll give you a quick exercise. Let's see how fast we can really do it. All of you have, each table, can there be one laptop, one computer? Might be useful. Open up the Excel sheet which was sent to you. We're not going to make you do the whole thing, but we want you to understand it at least, right? If Ashley wants to sit somewhere, just take my keys, okay? Or in the conference room.
Okay, yeah, you can move it. We don't need it. We'll be doing it with an Excel sheet.
Okay. There's an Excel sheet which is provided to you, right? You can just download that, right? Let's go through the case a little.
Sir, are there 3 people on each? One person, please join. There are only 2 people there.
Well, I don't know if, did you introduce Neha?
Yeah, she's
Okay, good.
Thank you. Yeah. Maybe we can go around and see.
Okay.
Is it?
So let me just describe the case to you, and then we'll have a look at it, okay? First of all, is everybody able to download that? Have a copy?
I think they were asked to download it yesterday, last evening. Pradnya had announced that.
You've done that?
Yeah. I'll just go around to see.
Can you just see if everybody has it? Just check.
What? F0.
How many of you have it on your computer now?
They're still getting it set up. Yeah, maybe then you all can come to one.
Yeah, it's okay as long as one of you has it. It's good because we wanted to discuss. We don't want necessarily. I think the time is short for you to do a full analysis, but you can do a little bit of parameter variations and see what happens.
Sit one.
Are you guys ready? You ready?
No, these tables are still getting it up.
You guys are ready? Ready? Not working. Did you put the right password? Still not working?
Who's got?
Somebody Wi-Fi
who's got
is
the
working
same-
or not? Working?
Who's got,
Okay.
Who's got the table who's got two Excel sheets? Maybe
This
you can
table.
come to this table, please.
No, don't do that.
Because
They
I'm
are a
still
group.
getting it.
Pre-assigned groups hai unke.
Oh, is it?
Yeah, yeah.
Okay, my bad then. Yeah.
Okay, this table is ready.
Yeah, good. One. Next.
They are also ready.
Ready?
Dr.
Okay.
Kulkarni is ready. Dr. Brahmankar's table is ready. This table is also ready.
Yeah, that's a
sure.
good idea. That's
Maybe.
I have it on my pen drive. I didn't think of it earlier.
1, 2, 3, 4 tables are ready.
Yeah, I have a pen drive.
Are you ready?
Are we done?
Rashi, your table? You want pen drive?
Yeah.
We have one copy
No,
now on pen drive. हाँ ठीक है.
There's one more here needed. There's one more needed.
Okay. She is transferring. I'll just give that to you.
That's okay.
There's a folder called Unit. Yeah, just take this entire folder.
Yeah, here.
Who wants? Here. Okay.
Hurry.
Yeah. There you go. Excel sheet.
Name of the Excel sheet.
Okay.
is, Unit Valuation.
You have a sheet there. It has 3 or 4 tabs. Right? The first one is the base case.
Are we good here?
Then there's another case which takes a situation where there's under regulatory pressure on the company, or on generally there's regulatory pressure. And the third case is what did it say? Yeah. So there's a new. You're treating it as a new tech. Okay.
No, we gave it from
Okay.
pen drive.
So each of you has an Excel sheet. I'm going to just describe a case, and then in your table you can just have a quick chat. We just want you to try varying some parameters and coming up with some conclusions. Okay, that's what you're going to do as an exercise, right?
This is not our slide.
This is no.
No, this is the deal
Oh,
structure.
sorry.
If someone has any question during the explanation, please raise your hand. We'll come to you with mics.
No, this is. Shall I start it?
Yes, please.
You can run through the Excel sheet.
Yeah.
So we're just giving you an example of a valuation sheet so that you can also use it later, understand how to use it, and also understand its limitations, right? There's nothing sacrosanct about any of these numbers. At the end of the day, all negotiations are between two people. As you know, if you see a painting on the wall, somebody values it more, somebody less, right? So value, there's nothing sacrosanct about it. Okay, it's always a negotiated number. Also, it's important to understand that these are heavily dependent on the assumptions you make, right, and the structure that you construct, right? So if you have very poor judgment, you will end up throwing numbers which are very, very off the mark, okay, and then you will try to defend it. So don't do that. Understand its limitations and use it for the purpose that it is supposed to be used. It is not like, say, valuing a house. Okay, even there is some judgment involved, but I'm just trying to say that it's not there's a lot of tunable parameters out here as well. Okay. So you have a case here which I'll describe. There's an Excel sheet which is a cash flow discounting example, right, which we have given it as an example. You'll understand it, discuss it, and let's change some parameters and see what happens. Okay. So we'll ask you for some questions which you can try and answer. Okay. So let's discuss the case a little first. Just 1 minute, I think. Okay. So the technology here is a low carbon process for production of a specialty chemical B. Okay, that's what is the process technology that you have. Now there is a catalyst C which is used for the conversion of A to B. So you are going from A to B, and there is a catalyst C that is being used. So what is your patent scope? You have a coverage on the catalyst, both the composition and process of making the catalyst, right. That's first you have to define what you have with you, right, and the process for conversion of A to B using the catalyst C, that's what you have. And the patent coverage you have here is you have US, EU, China, India likely to be granted, you have filed there, likely to be granted. Patent life is from January 2023 to December 2042. Okay. The value proposition, that is what exactly you are bringing to the table, is that this process that your inventor has developed provides a 10% higher yield, 10% higher yield, right, and there is significant reduction in the carbon emissions. That is what you have deciphered from looking at the technology carefully, after studying it carefully and then doing your value proposition analysis. You are the tech transfer officer for an R&D lab, okay, and your party 2 is a large Indian chemical company which already sells B. Okay, they are already selling B, so it is not a new thing for them, right. They hold majority of the market in EU, right, rather let me put it this way, majority of whatever they are selling is in EU, okay, take it that way. The global market share is 15%, that means they are holding 15% of the global market share, right, and they have already invested in a $20 million plant, right, 10 years ago. And they are making a margin of 20% on whatever they are selling currently. So they are holding 15% of the global market, most of it is EU, making a margin of 20%, right. And I am giving you some data points. Global market for B is $500 million. Okay. The market breakup, 40% is USA, 30% is EU, 15% is China, rest of the world is 15%. Okay. Market growth rate is 10% CAGR. The production of B, China controls 30%, India controls 30%, Saudi Arabia controls 20%. This is the industry, okay, not the markets, right, users, right, and rest of the world is 20%. Okay. So by the way, I am giving you those data points, but you have, of course, in real life you have to go and figure those out. You have to also gauge which is the right data to use. Okay, sometimes there are superfluous data, you may or may not end up using them. The price is $10 a kg. Okay, and price is increasing at about 3% per annum. The price is increasing at 3% per annum. Annual demand is 50,000 tons or 50 million kgs. Okay. Technology is at TRL4, the technology that you are proposing. If this company licenses it from you, they have to, there is a further development cost of $5 million for the next 12 months, right, and it is low because they have all the scale up facilities available already. The process is same. They've already done it in the past, right? They don't need to necessarily do too much more. They'll do with whatever, they have quite a lot of stuff, right? And the cost of the catalyst is the same as what is being used currently. So they are using a catalyst currently, cost is same. Okay? Agreed? So I will bring this back on and I'll leave it on the screen, but digest this a little bit. Okay? Okay, this is the case. Now we need to build a sheet to explain that. So just for a couple of points more. So let's understand the value proposition of the licensee. Remember, licensee already has a process. So what is the motivation for the licensee? Okay, so now if you think its yield increase of 10% is important, you need to figure out a way to put a value to it. Okay, so we'll think about how to do that. Like that increase. It could be any of these. Reduced barrier to enter EU, right? European Union is coming up with a carbon tax. European Union may ban products from certain processes, right? They want to reduce the carbon tax for selling in EU. Say the carbon tax will reduce margins. If the carbon tax kicks in, it will reduce their margins by 5%, right? Right now, what was it? I think it was 20%, right? It will come down by 5%, so it will become 15%, and their market share will erode because some buyers will say, we don't want you, we'll take it from a cleaner source. They might do that. Okay, so they'll lose about 3% of the market share. It's 15% right now. They might lose 3% of that. Okay. Pressure from Indian regulators to reduce carbon emissions, is that a motivation? And how serious is the threat? I'm asking questions first, right? I'm just trying to understand why are they interested in licensing. Okay. Pressure from shareholders to reduce carbon emissions, and how serious is that threat? By the way, I can tell you today some of our startups are being asked to provide ESG audit reports. Okay, that means they have to do an ESG audit of the company and provide it to the investor. So it's not this is not very far away. It's going to happen. Okay. It could also be keeping technology away from potential new entrants and competitors. I already control 15%. If my neighboring company buys it and does it, they will eat into me. So let me do that, right? And there could be other reasons as well, right? So if that's the case, how will you go about discovering the motivations first in this conversation? There are so many now. How do you find out what's the motivation? No. These are the motivations. Now tell me, how will you find out? Like you are sitting on the table with somebody who has come. What are you going to do?
First is go for mathematically find out how much yield will increase.
Yeah, but I'm asking you to...
How it will impact my gross margins.
So the reason I put it here is because the answer to this is not in the Excel sheet.
Yes.
Right? The answer to this is between the eyes. So you're looking in the eye and trying to figure out what is bothering him. Right?
Yes.
That's what Richard was saying, he will have a conversation. Ask him, tell me a little bit about your industry. What's bothering? Why is it interesting? Straight questions. Why not? Right? Understand what's bothering. And the reason I'm telling you this is the Excel sheet that you have. Okay? The different tabs. Consider different motivations. Okay? Because you will end up factoring in what is the value you are creating depending upon which motivation matters. Okay? Is that clear? So let's go with this. So what else can you do? You can ask them. What else would you do? Market survey for what did you do? What did you survey?
Yeah, to understand the technology and their competition and what's the regulator's point of view.
Yeah.
What all these.
Yes, you'll go and see how credible is this threat, who is pushing the buttons, when is it going to happen, carbon tax, what's the timelines, right? Have they in their annual reports mentioned that they're going to take some action about this because it's a publicly listed company, they might be writing about this? Is there a news interview of the CEO talking about it? You'll do all that, right? You'll also say, call up your friend who used to work in this company and say, why do you think they are interested? Are they seriously interested? Please remember that if they are trying to keep it away from the entrants, competitors, they might just be taking it to kill it. That's also possible, no? No, if that happens, you also don't want to give an agreement. You were thinking royalties you'll get, but you'll not get anything because they're actually killing it, right? So you need to understand what is their motivation and figure out what they are going to do with it as well. Okay, so a few thumb rules we'll use. We'll use our rule that Richard, I think, Dick mentioned. Yeah.
When its cost is less, so why even then why they will be?
It may not matter to them, right? It might be that they are already controlling 15% of the market. If their neighboring company produces it, right, it will eat into their market share, right? That 15% may or may not be important. It might be the market share is more important, right?
Point is okay that they can eliminate their competitors by acquiring this technology, but why they will be dumping this technology?
No, so suppose they have to implement it in their plant. See, they have an option. One is they kill it or they implement it in their plant, right? Now, if they implement it, let us say that they think that they're going to invest this much money, effort, and this is the kind of uncertainty involved. They'll factor that versus the cost that they are going to pay to take it from you, right? Now, they will factor all of those. If it is not worth doing it, that means that 10% thing doesn't result in a significant improvement for them, that you'll have to see with numbers. Does it make a difference? That is what I'm going to do, right? They can kill it. But you need to know, now upfront you don't know until you do the analysis and see what difference it makes for them. And by the way, there are cases like that, okay? They do that so that it doesn't hurt their current business, right? Because it's after all a right to keep away others, right, from that current business as well. And by the way, I'm not saying it's a wrong thing, okay? It might be a good deal for you if you want to do it, but you have to decide, right, whether that's the deal you want to take or not, okay? And it comes with its own consequences. Okay. Yeah, you had some question? No. So we'll just keep two thumb rules also. One we will say as just for calculation purposes, but there's nothing sacrosanct about this either, right? Which is that whatever profits they make in this, 25% is what is due to your technology. By the way, it's TRL 4, so it can be even lower, right? But the rest is because they are putting in all the effort, right, of setting it up, marketing it, selling it, getting the revenues in, all of that. So just for starters, we'll put that number, but it can be much lower, okay? We'll say that out of whatever is accruing to you, you will have a thumb rule that you will take 20% upfront, remaining you will take as running royalties, right? So whatever you calculate as the money coming to you, 20% you will take upfront, remaining you will collect as running royalties. So now we have to calculate how this whole sheet works, okay? So I'll request Neha to run you through the sheet, okay? And after that, we'll come back and put up the slide again with the assumptions. Yeah.
Thanks.
You want this?
No, it's fine. Okay, so we'll take up the first tab, which is basically plotting down all the assumptions and all the data that was put up on the first slide that Premnath spoke about in terms of the market share, the global market share for the chemical B. The appreciation in terms of the market share, what is the European market share. So all of that has been documented in the base case, right? So first we will take up business as usual, that there is no, that is whatever the motivations are as per the current, whatever was tracked before is as is right now. So that is what we're going to take up. Yeah, the current process.
As usual without any changes.
No changes,
Okay?
no pressure, nothing at all. So we are looking at that sheet. So has everyone got that first sheet open, the base case? So first, like Dr. Premnath mentioned, assumptions are something which is critical when we are doing any kind of valuation exercise, and rarely it is as easy as what has been plotted here. There's a lot of research that we need to do. But right now we have all the data that we need to go forward with this valuation exercise.
It's me.
So first what we'll do is we'll plot the trends, right? So in this, if you see from year 0 till the year till year 20, for 20 years, because that's the patent life also, the global market share is $500 million in year 0. Is that right? Okay, the market share for the European market is 15%. Yeah.
Okay. First is there is a section on assumptions. Based on these assumptions, there are some trends, right? All the numbers in red are assumptions. All the numbers in black are calculated. Is that clear?
Yeah.
Okay. They are not assumed. You can change the numbers in red and see what happens later. Below these trends, just can you see the sections, then you can go into the details. There's a cash flow simulation which has inflows, outflows, a surplus, taxes, and then finally you're calculating the surplus. Just one minute. Taxes, surplus after taxes, right? This is for the whole company as a whole. Okay?
Yeah.
Right? And this whole operation. Assume for a moment that this is the only thing that the company makes. Okay?
Yeah. Okay, so in column E, we are looking at $500 million of the global market share of the chemical B. Okay, in the EU market share is what we are saying is about 30%. So European market holds 30% of this particular chemical, which is 15 million. Okay, 115 million dollars. We already know the price per kg is $10 per kilo, and the market share of the licensee is 15% of the 30% of the European market. Is that right?
15% of the global market. Yeah. The global market.
15% of the global market. That's right. Yeah. Are you all with me? Yeah. Okay. So now the year-on-year increase that we are looking at is basically the $500 million plus 10% of the appreciation that we will see from year 0 till year 20. So this has already been pre-calculated, and if you go right up to the end to year 20, you will get the total market share at the end of year 20. Is that right? So same thing, the same formula has been tracked for the European market share, okay, for this specialty chemical, and for the licensee market share has also been calculated in row number 40 up to year 20. So these are the trends that we are seeing for this particular chemical. Now, when we actually calculate the cash flow simulation specifically for this particular licensee company, is what you see here, and this is important because this will actually help us determine the net present value and then the royalties and the upfront fee that we need to pay.
Neha, just let me add that the reason it is mentioned that they are major player in Europe is because Europe is the one that's really pushing the buttons for carbon tax. So here they are basically the key player in Europe. Okay, so most of their sales is happening in Europe.
Yeah. So how did we determine sales? So we determined sales based on the market share of the licensee that we had calculated in the trends table. So if you see, this is $75 million. We are in row number 49.
Yeah.
Is that right? So $75 million, and the outflows, which is the cost of goods sold. Is that right? Yeah, you okay?
So outflows are all your expenditures. So one set of expenses have to do related to the sales, cost of goods sold, and the development expenses.
Yeah. So also we had also provided the margin of the licensees 20%. Is that right? So $75 million, 20% of that is the surplus, which is also given here. This is $15 million. Right? And the cost of goods sold is, that's why, $60 million. So this is again extrapolated for the next 20 years based on the appreciation that we have seen of 10% every year on year. Okay? Is everybody understanding the Excel sheet and is with me? Yeah? Okay, great.
The cost of goods sold is assumptions or what?
No, you had margins, right?
Yeah, so
you had
80%.
margins available to you. So 80% I think is the cost of
That's
goods
right.
sold. 20% is the margins.
So margin
right?
on the license
So we
is
were able to calculate that through
Yeah.
that. Yeah.
Okay. Then we have taken a flat tax rate of 30% and arrived at the net profit after taxes after reducing the tax rate. Okay. So now what you see here is basically the surpluses after taxes for the next 20 years that is available here. Okay, and then the net present value of the company of this particular sales of the surpluses is calculated using the Excel. There's an NPV formula in Excel that's available. Using the risk-adjusted discount rate of 20%. This is also an assumed is an assumption that is mentioned here. Okay, so this is something that you all can play around with in terms of the discount rate, and this is why this Excel sheet has been created. So you all can see the net profit, the net present value will change based on the risk-adjusted discount rate that you all will, enter in this particular cell.
Just give me one.
Yeah.
I hope all of you can see it's NPV 20% and that whole stream of
From
cash
year
flow.
1 to
Okay.
year 20. Yeah.
So the general rule here is that there are any economic activity will provide certain cash flows, right? Net cash flows. You take those cash flows and see what is its value today. So one number, today's value compared, so for a stream which comes. So let's take, say, if you were to invest, okay, in a FD, right? You put 1 lakh. Every year you get back, say, 10%. So you'll get 10%, let's say simple interest. So 10%, next year 10%, next year 10%, so on. And then at the end of it, you cash that 1 lakh FD. You'll have a stream, right? 10%, 10%, 10%, then 1 lakh. What does all that add up to as a value, as a net present value, right? Correct? You invested 1, but you got something out. So maybe it will come to about 60,000 rupees or something in 5 years. That 60,000 is your net present value. That's what it is. Understood? So your basic, yeah.
Always applied to profit after tax.
Yeah. So here it is always after all. This is a cash flow that the investors really care about, right? They have to see the money that comes to them, right? The value of the company grows with the profits accruing to the company. They don't care about the taxes. Yeah. Okay. Right. Now, so this is till here. Everybody is with us, right? These principles are very simple. Rest you can keep changing. Is everybody with us? Anybody lost? Okay. Yeah. So by the way, this is a situation where the development cost is 0, right? Because you have taken the base case, because this company already
As a process.
has a process.
Yeah.
Okay. So we are trying to evaluate right now, as business as usual, what does it mean in terms of value? Now, the reason I am giving you this is, if you are developing a new process, right, and you went to this guy and said that I am going to be responsible for all this stream, right? That is an error that many people make, right? You will say, I have a new process, so you could be making all of this money or equivalent of it, right? But is that fair? Because he can already make money on it, right? You giving me a new tech doesn't give me all these money streams. I am anyway going to make it. You are going to give me something more. Now I want to know what that more is, right? So my calculation should not be based on this, but should be based on what is more. But to find out what's more, first I need to understand what is the base case. Okay, that's why we are doing the base case first, and then we will go to the next. But this is a common mistake people make, because they get a technology from somebody. They want to know how do I understand what money. They are assuming there's a new company that has come and has taken this technology and is making it possible, but it's not the same as an existing company coming and licensing it from you, right, with the same product being made. Yeah, go ahead.
Yeah, so moving on, we are looking at the surplus attributed to technology, and we had looked at the assumption, or those thumb rules that 25% of the technology will be assigned to the licensor. So now this is basically 25% to the tech from the surplus after taxes, right? Is that clear?
So imagine that this guy already has a technology, okay, from NCL, and now Neeri has come with a new technology. Now this is the NCL's technology worth, okay, the old technology, it's still worth this much, okay, because that's what's happening currently.
Yeah, and that is what again is extrapolated. 25% of the technology of the share of profits after taxes is assigned over the next 20 years. Okay. So what has been assigned to the upfront fee? We had also discussed that.
Yeah, what did we say will be the share which will we want upfront? 20%. You said 80% you're okay getting it later. So we're just splitting it into 20 and 80. Okay?
Yeah, I think it should be 20%. I'll just change that.
What does it say?
It has gone to the profit attributed to tax.
Okay, sorry. Yeah. That's my error.
But if company doesn't have the existing one, and the company doesn't have it,
Yeah. Yeah, we need to consider that case also. So if your licensee was new to the game and did not have a B, right, you can consider the whole thing. But you will not, as you will see, have the benefit of already having a 15% market share. Right? So numbers will be very different.
then ball game will be very different.
Yeah.
Investment and
Yeah, you will see that. You can try it out and you will see that it's a new company. You can't start with 15%.
exactly.
Right? So then the question is, who do you give it to? If by chance a guy with a 15% share comes or a new guy comes, right, and wants to do it, who do you prefer, right?
Yeah. Is anyone getting stuck? So this is basically the upfront fee is basically the surplus. The surplus attributed to technology into 20% that is apportioned to the upfront fee.
Okay, we'll just break.
Can you see the formula? No, see the surplus, that is the technology share of profits is 25%, but what we want to split that into is 20% as upfront fee and 80% into running royalties.
Sorry, what did you change to just now?
See, I've changed.
I hope it's 30 only, right? Okay.
This is 20.
A portion to this.
Yeah.
Yeah. Okay. Sorry. Yeah.
Yeah, I think, yeah.
See, all we are doing is we are just taking out of the profits, we are saying 25% is due to the technology.
Yeah, due to
right?
the licensor. Yeah.
Then whatever is due to the technology, we are breaking it up into 20% and 80%. Is that okay? That's all. Nothing more. Now 20%, why am I breaking it up? Because when I get all of this, I can add up all of this to find out what could be the total upfront fee.
But that is saying something 10% more.
This is your.
Yeah? No, so that I have not come to because I have not given the new technology yet. This is the base case, right? So what we will do is now, when the new technology comes in, we will see how the numbers change. Okay? Because for them, it is only a change in certain numbers, not the whole business, right? No, still lost? People are still lost?
Right. Yeah.
Understood?
Right. Yes.
Okay. So let's continue with this, right? So we have here two parts, assigned to upfront fee, assigned to running royalties, right? Now we have taken also the running royalty segment and divided it by the sales to get a sense of what would the number be for running royalties. Okay? Suppose I can break that 80%, I divide it by the sales, it tells me that roughly it's about 2.8% of sales in this business. Okay? Is that also clear? So now you can see I am getting a number for these kind of for the numbers which you are seeking, right, like running royalties and so on and so forth. Okay? Now these numbers are the value as of that date. Okay? The numbers which you have calculated so far is the value of the money as of that date, right? So in 5 years time, whatever number I got, that's what I have taken, right? But as Ashley said, there's a time value of money. So now I need to calculate its real value as of today, right. That is what we have done below, that by dividing it, right, by the 1 plus discount rate to the power years, number of years. Okay. So we know now that stream of money, the real value of it as of today after discounting. Okay, got it? So this is the present number, this is the value as of that date, and this is the value as of today. Okay, you can see that it is getting discounted, right? Now I take all of these streams here and add it up, I will get a total upfront fee here of this number, which comes to about $4.8 million. Okay, the total value for the technology was about, how much is it? $23.8 million. Upfront fee is about 4.8, and I should be asking a running royalty of 2.8%, right? This is for the base. Okay, now if all of you have understood the base, now we will let you understand, we will just explain what we have done in the next, and then you can think through it, okay, after tea. Okay, so let us just put that down. So now let us see what is happening here. Okay, yeah, sorry,
Just double click here.
yeah. So I think here, no, can you just correct that same calculation error, the 20% one, right? Okay, now let's stick to the next step. Okay, the next step we do is that we say, look, the same company has this current technology, right, but now it's under regulatory pressure. Carbon tax is going to kick in, right? What did we say will happen? They will lose some margins and they will lose some market share, right? Okay, now I need to calculate what will happen. So now first I am saying, if I need to calculate what they are worried about, right? I know what is the current thing that is happening, I want to know what will happen if carbon tax kicks in, okay, and then see what is the value I am going to create in case I am able to help them overcome that, right? I can't claim that entire $23.8 million I showed you as a technology thing, because I am not contributing to that, but I will definitely know what losses I am preventing for them if the carbon tax kicks in. Okay, so let us calculate that. So that is your second sheet. Okay, just to, I had made a mistake of that 20, it's 25, it's 25% I have taken, so 20% for the upfront. So those numbers you are changing just now. So you will just correct that, right? Is it okay? Yeah. So here, what did we change here? So these things in blue out here, the market share went from 15 to 12%, and the margin went from 20% to 15%. So now let us look at the numbers. Remember the last set of numbers, right? Let us look at these numbers. What does it say? It says that the upfront fee should be, instead of 4 point whatever, it is 2.9. Instead of total amount, considering everything, is instead of 24 it is 14. Okay, and running royalties, if you were to do that, it's 2.1, right? Okay, that means they are basically going to lose how much money? If you look at the total value in the next 20 years, during the next 20 years, they are going to lose almost $10 million out of $24 million in technology valuation part, right? But they are more in, they are also, you have to understand that even the NPV has gone down, right? From 95, it's gone down to 57. So not only the technology share, actually they are going to lose a lot more in company value. Company value is going to decline by half. Okay, you follow that? So this one development is going to create a loss for them which is considerable. So now this guy comes to you, right? You have done this analysis, so you know that if you offer this technology, right, what would you price it at, right? You know he's going to save $40 million. Okay, he's going to save $40 million actually, right? Of course, you can't capture all of that, but you have to now understand if your technology is put in now, how will the numbers change? Okay, so that's the third one out here, right? So we put the third one in now. This is the new technology situation, right? Okay, here also correction might be needed, but maybe you can just correct it quickly, please. Thank you. Now, what am I going to do? Now I am giving him the new technology. He is going to change over to the new technology. What will happen when he changes over? There is a development cost, and I think we calculated what? How much was the development cost? 500,000? Yeah. $500,000, right? So we have to factor that in as an extra cost which he has to incur. And his margins, we'll assume for a moment that he retains. Okay? So what happens in the assumption? Can you see the assumption here? It's back at 15%. He didn't lose that margin. And his margins is at 20%, right? But you said that he'll also get a higher yield. How will that be factored? Hurry, let's put you in a spot. How will you factor the fact that his yield has gone up? How? Think. What is happening when his yield goes up? Production cost comes down, right? So that's the other factor we build in out here, right? So here his expenses, right, come down because for the same amount produced he's doing it, or he's actually producing more for the same process time, which basically means he's going to do it at a lower cost. So you factor that in as well. Okay? Understood? So what did we factor in? Remember that we factored in the carbon tax, we first saw the threat, but it didn't come in this sheet because this is not creating, this is basically made him avoid that, but we need that other data point, okay? And now we are saying that his cost of production has decreased. So because his cost of production is this blue list here that shows the lower cost of production, you have a different set of numbers. So what's the NPV of the company now? $127 million. Okay? So what was it before? 90? 95. It was 95. But they could have gone down to 45, let's say. Okay? But now they are at 127. So what is the number that you are actually helping them with? Is it 127 minus 45 or is it 127 minus 97? Right? You understand? You have actually helped them from going down to 47 or roughly that much, right? So this you can also see that you can calculate for this also the kind of technology numbers and so on and so forth. So now what will you use for valuation? So I think these numbers are from there only, right? Yeah, okay, good. So this one is a final sheet which talks about it. What is the technology worth to the licensee? I am just putting some data points here, right? The value of the company under business as usual conditions was 95. Value of the company under pressure is 57. Value of the company with the new tech is $127 million. Okay. What's extra value being created? If there are no regulations, it's $32 million. If there is no carbon tax, if there is carbon tax, it's $70 million. And if there is a complete ban, it's $127 million. So now you are in a dilemma of what is the value. But we'll take for right now that we'll take about 1/4 of it as our value. Okay, as just a thumb rule. He will make the rest. 25% is ours, right? Could be any of these, right?
What is the complete ban?
That they completely ban this process. They say that we will not accept B coming from this process entirely because you are not meeting those standards. By the way, the European Union does this also as a non-tariff barrier, okay, in order to prevent people from selling in their countries. Okay.
We have not considered extra sale also. No? There may be extra sale also due to this green process.
It's quite possible that the extra sale also happens. You can factor that in also because only the assumption will change that, oh, because it's a, but generally speaking, you might increase your market share, okay, that is possible, so you can factor that in, but you will have to create a basis for it. I am just trying to illustrate to you that you may not have thought of these as sources of value, right, when you were thinking about it, because you will, first thing you do is you go and simulate the process and then you will say, oh, what is the process worth, but actually you have to consider what is it worth to the person because you are there, right, and that answer can be very different. So these calculations have to be done keeping in mind the motivations and what is going to happen to the person if he did not have the technology, right, and that is what I think is important. Idea is not to squeeze them, but the idea is to understand what value they are likely to provide for that, and why are they so keen on it. Now, as an aside to this, I just wanted to tell you, here is a little variation of it, which is what will happen if the technology is licensed to a new startup, new company that makes this, right. See, your original market share was 15% here, that is why you are seeing such large numbers. Try putting in the base case, right, say 0% or 1% and see what happens. The number will drop considerably.
0 for 5 years.
Yeah, like you just assume that then even if you just for numbers sake instead of that 15% put 1%, say a small company, see how much the numbers change, right. Okay. So you have to understand that your choice of companies may also be dependent on this, that if there is a large company with an existing presence in the market, they may actually be a good choice, but very often we do not have takers, then we have to work with smaller companies as well, right. What happens if the development cost is much higher? We did a recent case for a drug where we had to put in $500 million of development cost into that calculation, right. But very still you do make money, but I am saying that you have to put that in and understand that the licensee is going to have to do all of that, So obviously it is by the way, all that is done when the market size is large, but typically you won't get that kind of numbers for your license fee, okay.
Where are we calculating the upfront fee and running royalty? We have calculated it in all the three, right?
Yeah, so I wanted to just show you that if you could calculate it this way for all three of them, but in this case suppose you are licensing to them, right, you will consider where you want to be, like this new tech licensing, you will consider that, you will calculate this saying this is what the technology is worth, right, but you have to consider the fact that first fellow has a technology already, right, you also have to consider the fact that what he could potentially lose, right. So it is not such an easy number, but you have a base, you have a number from the new tech calculation, okay, for that technology, okay. But this number you will see is 29.7 and 5.9 upfront, right, if it is 29.7, but you could actually see that there could be more money accruing here because you are
like, my question is, where are we using those numbers for the calculation?
No,
because
here we are back calculating what is the running royalties.
Yes.
We are not trying to use it anywhere.
In this case also, like, it is completely stating that that 10% yield is also there and that technology itself is completely new, right?
Yeah, so the new technology is providing the 10% increase in yield,
yes,
which basically reduces the cost.
Yes.
So when you do the calculations, if you were to do these calculations like this, you will see that you would have estimated a upfront fee and a running royalty of this number, which
yes,
we have listed here. That is what will come to, if you did a vanilla calculation. Okay, so I'm just showing you that. Now, how you use this in a term sheet, right, is a different matter.
Okay.
When you put that in a term sheet and you say this is the number we'll agree, right, your range could be from, the value of the company could be of the technology could be go from 29.7 to it could even go up to much higher. Okay, that's also possible.
How much higher? It can vary from 8 to 32.
Yeah, 8 to 32 is a range, is one set of range in this, assuming all your assumptions play out. Okay.
Here we have valued the technology of 30 million ton.
Yeah. Yeah.
It is on higher side according to this.
It's okay. This is one set of numbers. You have a range. Now within that range, I don't take it as hard and fast. Okay, valuation is never hard and fast. It is a matter of good judgment in terms of what the guy is willing to pay, how desperate he is, what he needs, what we want to do strategically. Maybe he'll come back with 2 more projects, whatever it is. So you have to take it with a pinch of salt. It is not about taking it as hard and fast numbers. Other thing I wanted you to point out is we assumed a certain discount rate, right? I think he showed you that the hurdle rate for venture capital firms might be 50%. Okay, so there it will plummet. Things will plummet very, very quickly. You can just put it down and see for yourself in any of these numbers. If you look at the NPV of the company, if I was to change this number to 50%, okay, you will see this coming down. Is right? Yeah. To 95, it's gone to 29 million. Right? Okay. So this is also something which you can calculate and see. We actually get our startups to do this analysis just for learning what is the tool, which are the levers that are changing. Okay, not to take that number as hard and fast. Okay, that doesn't work. Okay, at the end of the day, you have to just close the deal. You have to figure out a way to make it happen. All these are thumb rules, right? You can always, it's why should it be 20%? Why should it be 25% share? Maybe it's not worth that much. Maybe your TRL level is too low. So there are so many factors over there, but it's a good starting point to understand all of these things. Okay, I think we'll stop with this. We'll go to tea and then we'll come back. Okay, you guys have to work on it yourself in terms of plug in some numbers and see how it goes. Yeah, I'm not trying to complicate it. So when you say interest, you're thinking of a loan, right? Yeah. No. So when you're thinking of loans, you start thinking about cost of capital and those kind of things, right? Those are further details.
You can add that to the expenses.
Right? You can do all of those things, but it is at this time it's not worth discussing those details. But if you're doing a great detailed calculation, all that you will do. Right? So, see, by the way, when there's an ongoing business, okay? When there's an ongoing business, you have a lot of data already. There you can afford to do more, accurate calculations. Usually in tech transfer, you cannot do that. Okay? There will be lots and ifs and buts about assumptions. I can tell you those assumptions which I have given you, it takes us a lot of time to get that number right. Okay? That's the hard part of what are the assumptions which we need and what's the data point to get that to get it right. Okay? So anyway, so lessons, understand the motivation of the licensee, then design your calculations. It's a method of calculating value, but what you put in your agreement depends upon what losses they will have if they don't take it. It can depend upon what additional gains they will have, all of those factors as well. Okay? And then, you can calculate accordingly what the numbers are. Okay, let's break.
Thank you. Let's give them a round of applause and